Hey everybody, Jonathan Broadbent here, your host of UnWoke.Academy. We are live right now on Rumble, X, YouTube, Facebook, and Substack. Welcome to another weekly Wednesdays at noon Eastern time. Every week I try to go live at exactly noon, or well, we're about 2 minutes after, as close as possible to noon Eastern time every Wednesday, and bring up important subjects and topics that I hope you find helpful. One of them that I want to highlight today has to do with working with financial professionals. At the end of the day, I think the starting point we should all have is recognizing that all financial institutions and the professionals that work there in financial organizations, they expect to be compensated. They expect to receive some sort of benefit, some financial, in most cases, lucrative for them, part of the relationship with you. With that as a starting point, you should start asking the question, if you're not already, how do the financial institutions and those professionals that you interact with, how do they get paid? And how much do they make? Because that's a key starting point to a lot of the conversation that I've been driving for a couple of decades now, that, well, not that long. It's 2009, I really started in earnest talking about flat fee sort of environment. And that's what launched something called fee-based 401k, fee-based 403b, and then ultimately led to the launch of my company. But the same holds true for individual personal investment accounts. And that is a clear and, dare I say, obvious way of eliminating advisory fees and investment management fees. There is a trade-off because if you're doing trading and building something, if you're building an investment portfolio, the organization that's helping you to build that, and that's usually a website, web-based tool that allows you to trade stocks and build a portfolio, they will have some sort of trading fees. But at this point, there's so much competition out there that those trading fees in general are pretty nominal. You're talking about very low fees. So, and it's actually fairly easy to do an apples to apples comparison and put side by side. I'm just going to venture the ballpark off the cuff guess that most people who are doing some form of investing, and it's usually an array of 401k, maybe IRA account, might have a stock portfolio outside of retirement savings. Some people have something called a 403b, but let's just ballpark and put a price tag on that. Let's say that between the advisory fees and the sometimes their insurance fees and the investment management fees, pretty much all of which are typically hidden from you and obscured, let's just put a figure of $7,000. It may cost you, it might surprise you to know that, or to learn that you're paying $7,000, whatever that figure is. And again, I want to encourage you to know that. And the thing is, it's a weird sort of a misnomer. Am I using the term correctly? Misnomer. It's counterintuitive that the more regulations have pushed for disclosure, because it used to be very difficult to find out what you're paying those people. Well, now there are all these rules and regulations that require disclosure of those fees, along with conflicts of interest that those organizations and those people you interact with may have. But I think that those organizations have done a good job, unfortunately for us, of burying the details in a mass array of different mailers and websites and disclosures. And sometimes you get those, they're like an end user license agreement, which is one of those online web-based things that you have to click through in order to use software or access a website. Oftentimes, those are just, I mean, it's like a week's worth of reading, and you have to go and get your law degree in order to understand it. And unfortunately, sometimes finance works in the same way. Well, there are some clear avenues and some things that I pointed to that can help you figure that out fairly easily. One of them, if you have a 401k plan, is to look for that fee disclosure that comes in the mail, and you can extract from that, you should be able to fairly easily, what you pay per year. So let's say in your 401k, you're paying 5,000 in fees or whatever it is. That is an amount that can very easily go to zero. If you put yourself in a position of negotiating directly with a financial institution and paying fees directly. So what does that look like? In an IRA account or 401k account, with all those fees that get siphoned off, you can very easily know that you might have to work. And I actually did some estimates and calculations in a previous podcast about 2 months ago, where you might pretty easily figure out you're going to have to work a couple of extra years in order to make up that difference. According to the calculation I came up with, the average person might have to work another 2 years in order to make up the fees that get kind of siphoned out on a small basis, on a regular basis, ongoing. So what if, it's not a what if, a lot of people actually do this, but not enough in my book. Think instead in terms of the company that offers the 401k working directly with an advisor, or you, if you have a financial planner or financial advisor, ask about your ability to simply pay those fees directly. Two things happen. One is the fees become transparent, and oftentimes you end up paying less. So let's use that estimate that I threw out of, let's say it costs you 7,000 a year. That is, again, just a ballpark, across the board, national average sort of fee estimate on my part. So let's say that it's or $7,000 that you are paying between the different accounts that you're investing in. Rather than have that money subtracted out of your account, what happens if you simply pay directly from a check? Shouldn't care. If they're getting paid to work for you, they shouldn't care where it comes from. Well, there's the wrinkle. There's the caveat. They do care because it's known, it's an open secret that if the fee is hidden from you or really difficult for you to figure out, you're more likely to just sort of like roll with the punches, if you will. If you can navigate getting to a flat fee, generally speaking, you're better off. And you're certainly better off in that account. So your 401k or IRA or whatever the returns are and whatever the investments are, mutual funds or whatever you're investing in, that is the one tried and true way that you know that you will have a better result. If you are, I mean, it's just common math. If your investments are returning 7%, but somebody's subtracting out a 1% fee, your actual return, if you drop the fee that you're paying, get rid of it, you actually realize the 8%, not the reduced. And that works in the negative too. Let's say the markets go down. Nobody wants that. But if the markets go down and tank, you're paying the fee on top of that. So your losses are worse than they need to be. So for those reasons, that conversation has actually proven very successful through the years. I've talked to a lot of companies, and I can't even begin to describe the encouraging feedback. I mean, there was a big hospital system. I was invited in and ended up serving for a while. It was in disarray at the time. We cleaned things up, reorganized things, and restructured the fees and got rid of the advisory fees. We actually were able to eliminate a number of conflicts of interest that were in there, and some really bad investment things and insurance things that were happening. It was actually murky and really bad. We cleaned all that up and got rid of it. And I was happy to do it for a clear, transparent, outright flat fee that the hospital, they paid me directly, which means nothing. None of the hospital employees paid a dime for me to come in and do all that cleanup work. And meanwhile, the fees that had been subtracted from their retirement plan for forever, they went to zero, which means they kept more of their money in their account. And if you like that old adage that's attributed to Albert Einstein, I think it was Einstein, according to my web searches, who said that the single greatest power in the universe is the power of compound interest. And if you leave your money alone and stop sending it away, stop allowing companies to siphon and subtract out of your account, you're better off. And I've related that a few times to some of these gimmicky kinds of deals where you authorize companies to subtract out of your bank account. I think you're better off. I know this is sort of a loose analogy, but I think it works. You're better off if you negotiate with that company directly. I don't care what it is, a utility or gas company or whatever. Because if you sort of leave it out of sight, out of mind, then who knows what happens to the fee? They might jack it up a little bit. And suddenly you find that you're paying more. And a few years go by, if you just give them free access to subtract whatever they want, then suddenly you realize that the fee is higher. Well, that happens in those investment types of accounts as well. Sometimes the fees go up, and if it's not obvious, they can get away with it. In a flat fee relationship, they can't, because you are agreeing to pay them directly. It makes everything clearer and more transparent. That is the claim to fame for the company that I built. We got recognized. Was it over 10 years ago? I officially launched in 2012. In 2012, I met with people on a national level who were recognizing just the simplicity and beauty of making that type of offering. I would still say it's very rare for companies to immediately kind of get that. Sometimes they have a CPA, sometimes it's a lawyer, sometimes actually it's even a payroll company, because there are payroll companies that call. I just got a call from another one a few days ago. They're interested in people like me that can come in and service the 401k plan because they can't. And they're surprised to hear that conversation, that instead of burying whatever, 0.5% in fees and sort of siphoning that out of all of the employees' accounts and then filling my coffers, I know, and I've learned in the mid 2000s, it was 2006, I was actually doing fee disclosures. Back then it was manual. Close your ears, young kids listening to this. This will startle you, but I was actually using an Excel spreadsheet, and I would create these and then get them reviewed by legal, and we would create these manual disclosures to big companies. I did law firms that way, public utility commission. I did all kinds of stuff, and that led to this claim to fame. But you wouldn't believe the number of times I did these things and presented them to a board of directors or the HR and benefits office, and they're shocked to figure out just how much they're paying in fees. And it gets, the bigger the plan, often the worse it is. I've listed as an example, and it's kind of one of those premier. It's certainly not the only one. Years ago, there was a very large plan with a lot of employees that had, at the time, it was a little over $1 billion in it. Now it's more like 2.9, I think, the last time I looked. But at $1 billion, the advisor to that plan was getting paid over $1 million a year. That's just one plan. And so the advisor, the plan advisor, whatever you want to call that person, would show up every once in a while and do enrollments and do education. And then, by the way, they were also selling ancillary personal investment products to the people that were employees there. That's a different topic for a different conversation, but I formed a company that doesn't do that. And that also was a standout decision on my part that drew a lot of positive attention. Not crossing over, not crossing streams, and selling other ancillary stuff to the employees, because that's a huge moneymaker. But imagine having one relationship as a financial advisor that pays you over $1 million, and then you can go and cherry pick and sell individual personal investment products to the people. That's just a bad, murky world. And that's exactly the opposite of what I encourage people to look into. You can advocate for yourself. You can advocate on behalf of your company's 401k plan. Those are options. You can get those. You should be able to. If you can't, then make changes and move it to somewhere where you can. You can work directly with an advisor. And if your company, let's imagine that your company is profitable. I hope they are. And I hope they're very profitable and very successful. If that company can simply, it's typically paid on a quarterly basis. If they arrange some services that they want, plan advisor services, and let's say it's they want 4 times a year, they want somebody to come in and do education, and they want assessments of the different investment options, whatever it is. You spell it out and it becomes a contract, and the company pays that advisor, fill in the blank. I went down for the conclusion of 2025 to a flat fee of $5,000, mainly because I know that there are a few other firms out there that can do that and go that low. I've created mass efficiency so I can do that, whatever it is. If the company wants to negotiate a $25,000 a year flat fee to the advisor, the chances are they're very, very good that the amount the advisor makes will be clearer, more transparent, and probably less than they're currently making. I did some other calculations in a previous podcast, just like this one, that showed the average annual plan fee is probably around $73,000. That includes, of course, some of the very, very large plans and some of the big high fee small plans. But even if you reduce that to, let's say, advisors who work on 401k plans, just round down to $50,000. If you can reduce that, then you're creating transparency, and that's $50,000 for all those employees of your company that aren't being subtracted from. It's $50,000 that works like a raise instantly for you and all of your coworkers. Look at it that way. That's what sells it. When I get opportunity to go in and talk to HR and the CFO of companies, sometimes the CPA is there, they get it. Because when you're talking about leaving 50,000 or 73,000, by one calculation, I think we were at 97,000. It really there's such a range of different fees and how they're taken out and sizes of plans. It's difficult to create an exact estimate, but let's just round to 50,000. Wouldn't you rather, you just think for a moment, close your eyes and envision all of your coworkers, wherever you work. What if it's $50,000 that's currently subtracted out of your accounts and goes to pay somebody? And what if the $50,000 never leaves and you keep it? If your company pays directly, that's what happens. The same thing can apply to individuals with IRA accounts in different places. Go to whatever financial institution, your bank or insurance company, or whoever holds the IRA accounts, and ask them, is it possible to simply pay a flat fee? If, and this is a plug for some of the work that we're doing, it doesn't mean you have to come and work with us. We'd be delighted if you do. But I launched the financial PMA for that and a few other reasons, because I know that works. Nobody can argue that it doesn't. Find me anybody with above a second grade math skill who's going to argue that eliminating fees doesn't make your account better. You won't find that person. But so I launched the financial PMA in order to encourage people to consider that as an option. Also, as a component of the financial PMA, I created it in reaction to some things that I was seeing from regulators. Regulators are pushing very hard, and this goes back to Wall Street and globalist banks. They're keenly interested in data mining. They're collecting information on people, and that doesn't sit well with me. So part of the intention of the financial PMA is to try to create some autonomy, some privacy protections for you and your financial life. I'm going to give one example. I'm not advocating for cryptocurrency. I don't really have much of a comment on cryptocurrency, but I know a lot of people buy and hold crypto. Financial firms are tremendously interested in knowing what crypto you own. Well, you shouldn't have to disclose that to government. It's not their business. That's my position. The financial PMA seeks to try to create an environment where that's possible, where a few things. One, that's important to know is the financial PMA. I'm saying this for two reasons. One is I hope that more people embrace it and will love the chance to work with you, but also I hope that other financial professionals take the model that we've developed and duplicate it. If you know people or your financial planner or advisor, encourage them to consider this as an alternative. It's a complete change from the penned in, over-regulated environment where the data mining occurs, where there's huge pressure to sell only a few certain types of products. There's mass consolidation of markets, and there's that the pressure, the data mining. I think I said data mining twice. And the third thing that it accounts for is what's called asset gathering. There's a huge push in the financial world for financial professionals, fill in the blank, some mutual fund company that also owns a bank, that also owns a credit card, that also does insurance. They want to get you into one little basket. The financial PMA doesn't do any of that. I set it up in a way that it doesn't matter where you invest. If you have one of those online trading apps, or you have a bank that you like, or you like an insurance company, we'd love to encourage feedback, because we talk a lot in the financial PMA about what we like Old Glory Bank. I've brought them up a number of times because I like them. No affiliation, no connection, but they're a bank that I like. I admire them. I think they do a good job. If I were in most any other realm of finance, it would be difficult for me to talk about Old Glory Bank, because there would be huge pressure on me to try and get you to whatever, some other bank that they own. The financial PMA works differently, and it doesn't matter. It's agnostic on where the money is. It's just trying to find better, less homogenous, consolidated markets, and that's paid off. To share with you the most recent data on Monday, 2 days ago, I logged in and looked at the most recent returns for that account that I've been reporting on that opened up, and I actually helped trade on October 8th of 2024. So through Friday of last week, that account is up 50, wait, no, it's 57.20%. I actually have it in my notes, but I don't have those notes in front of me because I did that on a separate podcast. It's 57.20% that account has returned. I believe that that is just a clear indication of what's happening under the Trump administration and moves to open up free markets again because they got arguably way too consolidated with too few companies actually getting invested in. Well, Trump said, enough of that. It's time to reopen capital markets. Let's get money back out there to companies that have been cash starved. They need it. And it's been a beautiful thing ever since. So that rounds out the plug for what we're doing. I hope you'll consider it, or as I said, find some avenue to duplicate the things that we're doing. Take all that we're doing and push it at your financial institution, at your company with their 401k plan. Call us. If you have a financial advisor, put them in touch with me. I'll walk them through it. I've gotten to the point a long time ago and just feel that more of us need to be addressing these matters. We need to be talking about the far left, uber left, I call it globalist influence on woke Wall Street. Because remember that expression, I coined it a while ago. What we fund today becomes the future that the next generation inherits. Do we want the next generation to have around 30 companies that control everything in all aspects of life? Or would we rather have free market economy with with capital markets that are open, where you invest in companies that might become the next new great thing? That I had this conversation last night. It was a guest on a friend's radio program. Thank you again, Russ Van Wormer. Russ Van Wormer and the Hometown Heroes. I was on his show last night, and I brought the same subject up. We need to be paying close attention to what we're funding and giving free market opportunities to the next generation. So if you imagine somebody has some idea and they build some garage business, they're going to need financing at some point. And if they're crushed instantly by mega company, by globalist cabal, they can never flourish. They can never thrive. We can never have the next new thing. That's a great environment for those 30-ish companies that destroy all competition before it even starts. But that's not what we want. If you're listening to this show, we want free market economy. That's what I brought to today's conversation. I am looking at comments as per usual. I am live right now on Rumble, X, YouTube, Facebook, and Substack. Substack is actually a separate configuration because we have not yet figured out how to use a desktop app to go live on Substack. So I'm using my phone and mic for that. But I am open to conversation and questions. If anything I've said here spurs some interest, feel free to add some comments. I will try my best to incorporate that. If you're not somewhere where you can speak or you have questions that occur to you later in listening to a replay of this, email me at jonathan@unwokeinvesting.com, JONATHAN. You can see it in the lower, what would it be, the lower left-hand corner of your screen, jonathan@unwokeinvesting.com. And together we can do this. Let's get you out of harm's way, out of the globalist bubble, and potentially, if you want to pursue my recommendations, get rid of those advisory fees and the investment management fees and create something that is probably significantly less expensive and way more transparent. That's the mission. That's the objective. Wherever you are and whatever platform you're using to watch this, I appreciate your time. Thanks for tuning in and have a great week. Bye, everyone.